Two men, same city, same year, same $50,000 sitting in their bank accounts, same income, same age, same starting line. 20 years later, one of them hasn't slept properly in a decade. The other just got back from a 2-week trip to Japan. And the strangest part, their net worth is almost identical. Before we get to the numbers, ask yourself something. When you think about a smart investment, what do you actually picture? A property? Rent checks? A tenant paying your mortgage? Or does your mind go quiet because you honestly don't know? That uncertainty, that's the gap this story lives in. This is Jake. He did everything he was told a smart investor should do. He bought property. He collected rent. He built equity. His friends were impressed. His Instagram showed receipts. And for the first 5 years, he looked like a genius. And this is Marcus. He did something that looked almost embarrassing by comparison. He opened a brokerage account, set up an automatic investment into a total market index fund, and then he basically forgot about it. No tenants, no repairs, no stress. Just boring, invisible compounding. For years, people like Jake will outscore people like Marcus on paper. The cash flow looks real. The appreciation looks real. The feeling of doing something is deeply satisfying. But there's a version of the story that nobody shows you. The version where doing something costs more than you ever calculated. Year 0. Jake takes his $50,000 and puts it toward a rental property. Purchase price $200,000, down payment $40,000, closing costs eat the remaining $10,000. He's leveraged 4-to-1 before he's even handed over the keys. That same week, Marcus deposits $50,000 into his brokerage account. Total market index fund, low cost, diversified across 4,000 companies. He sets up Auto Invest for $500 a month from his paycheck. Then he closes the app. That is the last time money requires his full attention for a very long time. Month 1. Jake gets his first rent check. $1,400 lands in his account. He screenshots it. He sends it to 3 friends. One of them texts back, "You're literally printing money." And for one beautiful moment, it really feels that way. But the mortgage payment is $1,200 a month. Property tax, another $180. Landlord insurance, $60. Jake's net operating income in month 1, -$40. He made $1,400 and came out behind. And he didn't even know it yet. Marcus's portfolio in month 1, down 1.3%. He doesn't check. He's at a friend's dinner. He laughs at something. He eats well. He sleeps 8 hours. This sounds trivial. It will not be trivial in 20 years. Year 1. Jake's property needs a water heater. $800 gone in a Tuesday. Not an emergency, just maintenance. This is the part of real estate investing that the YouTube videos skip. The random Tuesday expenses that arrive like a subscription you never signed up for. The real estate industry has a rule of thumb called the 50% rule. Roughly half of your gross rent will be consumed by expenses not including the mortgage. Vacancy, repairs, management, taxes, insurance, capital expenditure. That $1,400 a month, effectively $700 before the mortgage even shows up. Year 2. Jake's tenant stops paying rent. Not late, gone, disappeared. Eviction process, 3 to 5 months in most states. Legal fees, $1,500. Lost rent, $4,200. Jake's passive income just cost him more than a used car. Marcus in year 2, his portfolio is up 11%. $50,000 became $62,000 on paper. He added $12,000 in contributions, combined $74,000 in 24 months. He hasn't spoken to a plumber, a lawyer, or a tenant, not once.
Here's what nobody explains about leverage. When it works, it's spectacular. When it doesn't, it compounds against you just as ruthlessly. Jake borrowed $160,000 at 6%. The interest alone in year 1 was over $9,000. He paid $9,000 for the privilege of owning a problem. Year 3. Jake refinances, gets a slightly better rate, Closing costs, $3,000. He puts a new tenant in, seems stable. His friends still think he's winning. Jake thinks he's winning. The spreadsheet tells a different story, but Jake hasn't built that spreadsheet yet. This is where behavioral economics meets real estate reality. Sunk cost fallacy. You've already put in so much, the effort, the money, the identity. You tell yourself it's worth it because the alternative, admitting you chose wrong, is psychologically unbearable. Year 4. Property value rises 15%. Jake's paper net worth jumps $30,000. He refinances again, pulls out $20,000 in equity. His friends are calling him a real estate genius. One asks him to teach them how to do it. He agrees. He barely knows how he got here himself. Let's pause here and do the real math that nobody does in the moment. Jake has a property worth $230,000. He owes $152,000 on it. Equity, $78,000. On paper, it's great. Off paper, he's worked over 400 hours managing this asset in 4 years. Marcus at year 4, portfolio value, $111,000. He contributed $74,000 total. The market did the rest. Hours spent managing it in 4 years, approximately 3. 3 hours. He spent less time managing his wealth than Jake spent managing a single leaky faucet. Year 5. The market corrects. Stocks drop 18%. Marcus's portfolio falls from $111,000 to $91,000. He gets one notification. He doesn't open it. He's hiking. The mountain doesn't care about the S&P 500, and neither does he, because he knows what a down market actually is.
A down market for an index fund is not a disaster. It's a discount. Every $500 Marcus invests during that correction buys more shares than it did 6 months ago. He's buying ownership in 4,000 companies at a sale price. This is compounding's dirty secret. It loves a crash. Jake in year 5. The market correction hits real estate too, indirectly. His tenant loses their job, asks for a rent reduction. Jake reluctantly agrees, $1,200 instead of $1,400. His cash flow, already thin, goes negative. He starts covering the gap from his own salary. His passive income now requires his active income to survive. This is the hidden cost nobody calculates, opportunity costs. Every dollar Jake spent on repairs, on legal fees, on carrying a vacant property, that's a dollar that never entered the stock market. It's not just the money you lose, it's the compounding that money would have done for the next 15 years. Year 6. Jake's property is now worth $245,000. His equity has grown. On paper, the investment looks great. But here's the question nobody asks. What is the actual return on invested capital after every real cost? Not the sticker price, not the appreciation, the real, total, all-in return. A Harvard Business Review study found that individual landlords overestimate their rental returns by an average of 3 to 5% annually because they don't account for their own time as a cost. If you spent 40 hours managing your property last year and you value your time at $30 an hour, that's $1,200 of invisible cost that never appears on any statement. Marcus at year 6, portfolio at $128,000. The market recovered and then some. He's promoted at work. He had the mental bandwidth to perform. No midnight maintenance calls, no tenant dramas, no financial anxiety bleeding into his Monday mornings. Year 7. Jake gets a call at 11 p.m. on a Wednesday. Burst pipe, flooding. Tenant is furious. He drives 40 minutes in the rain. Emergency plumber, $2,200. He gets home at 2 a.m., alarm set for 6. This is not an edge case. This is landlording.
There's a word for what Jake is experiencing. It's not investing. It's operating. He isn't a passive investor. He is a small business owner with a single asset, a single tenant risk, no sick days, no HR department, and no exit strategy that doesn't cost him thousands in transaction fees. Year 8. Something shifts. Jake starts doing the full math. He sits down on a Sunday afternoon with a spreadsheet, and for the first time, He puts every cost in, every repair, every month of vacancy, his own hours at a generous $30. He stares at the number for a long time. Then he closes the laptop. His true annualized return on the property over 8 years? Approximately 6.2%, including the appreciation. Not bad, but the S&P 500 averaged 10.4% over the same period, and Marcus didn't drive anywhere in the rain, not once. Here's what 6.4 versus 10.4 means over time. Start with 100,000. After 20 years at 6.2, 331,000. After 20 years at 10.4, 723,000. Same money, same timeline. One decision, a $400,000 difference. But wait, this is where the story gets complicated, because Jake's leverage changes the equation. He only put 40,000 in, not 100,000. When you factor in leverage, his total return looks different. This is the seduction of real estate, and it is a seduction. If you put 40,000 down and the property gains 30,000 in value, that's a 75% return on your down payment, even if the property only went up 15% in total. This is leverage working for you. This is why real estate makes people feel like geniuses, even when the underlying numbers are mediocre. But leverage is a multiplier for both directions. The same force that made your 40,000 feel like 75% gains will make a 20% drop in property value feel like you've lost your entire investment, and then some. Leverage doesn't care which direction the market moves. It just makes the movement louder.
Year 9. National recession. Jake's tenant loses their job. Property values in his neighborhood drop 11%. His equity, which was $78,000, is now $44,000. He still owes $138,000. He is not underwater, but he can see the waterline from where he's standing. Marcus, during the recession, portfolio drops 22%, from $150,000 to $117,000. He increases his monthly contribution to $800. He reads a book about the 2008 crash. He is not worried because he has read about every bear market in history and knows how each one ended. Here's the psychological difference that changes everything. Jake can't wait out the recession. He has a mortgage payment due on the first of every month. He cannot decide to hold. He has to perform regardless of market conditions. Marcus can hold forever. Time is on his side in a way it will never be on Jake's. Year 10, halfway mark. Jake's net position. Property worth $210,000, owed $128,000, equity $82,000, plus $20,000 equity he pulled out earlier. Total real estate wealth approximately $102,000. But he's also worked roughly 600 hours managing this. That's 15 weeks of full-time employment unpaid. Marcus at year 10, portfolio value $219,000. He contributed $110,000 over the decade. The market gave him the rest. Hours worked, approximately 8. He didn't manage anything, he didn't lose sleep, he didn't miss a single dinner. This is the moment where most people stop the comparison and declare a winner. But that would be the wrong call, because real estate has something the stock market can never fully replicate. And it's not leverage. It's the psychological feeling of owning something real, something you can touch, something your name is on. And that feeling is worth something too. Year 11. Jake raises the rent. Market rents are up. His new tenant pays $1,600. Cash flow turns positive, finally. $200 a month after all costs. He feels vindicated. He tells his story at a barbecue. Everyone nods. 11 years for $200 a month. But he doesn't say that part.
Year 12. Jake gets an offer on the property. The developer wants the whole street, offering $270,000. He could sell. He'd net $112,000 after paying off the mortgage. But he's emotionally attached now. This is his. He built this. He's not selling. Identity has become the jailer. This is a concept called endowment effect. We value things we own higher than their market value, simply because they are ours.
Jake's property is worth $270,000. In his mind, it's worth more. So he holds, and the developer buys the property next door and builds condos, which actually increases Jake's value. For now. Year 13. Jake's roof needs replacing. This is a capital expense, not a repair. $18,000. He knew it was coming. The inspector told him 8 years ago. He just kept pushing it. Now it's here. And it just erased 9 years of positive cash flow in one invoice. Capital expenditure, CapEx. The item that destroys landlord spreadsheets everywhere. Roofs, HVAC systems, water heaters, foundations, electrical panels. These are not if events, they are when events. And if your investment model doesn't account for them, your model is fiction. Marcus, at year 13, $291,000 in his portfolio. The market has had 2 corrections and 3 major rallies in 13 years. Marcus experienced all of them from the comfort of not checking his phone. No $18,000 surprises, no invoice that changes everything, just growth. Year 14, Jake hires a property manager. He's exhausted. He's missed 2 family vacations. His marriage is under strain. Money stress does that. The manager charges 8% of monthly rent, $128 a month. His positive cash flow is now $72. He's trading time for money, but now it costs money too. There's nothing wrong with hiring a property manager, but the math matters. If you buy real estate for cash flow and management fees eat that cash flow, you are now just paying someone else to give you the appreciation of a leveraged asset that you could have gotten unleveraged through an index fund, while someone else does all the work for free.
Year 15. Market boom. Jake's property is now worth $340,000. His equity, after paying down the mortgage, is $180,000. His total investment over 15 years, $40,000 plus approximately $31,000 in out-of-pocket costs. Net return, $109,000 on $71,000 invested. That's 153% in 15 years, or roughly 6.1% annually. Marcus, at year 15, 4,300 companies across 11 sectors and 27 countries. If one company goes under, he barely notices. If one sector collapses, he barely notices. If one country's market crashes, he barely notices. This is what diversification actually means, not spreading around, disappearing the risk. But here's where every real estate investor pulls out their counterargument: tax benefits, depreciation, mortgage interest deduction, cost segregation. These are real. They are significant. And if you know how to use them, they absolutely improve the numbers. This is not a myth. It's just more complicated than most landlords admit. Depreciation alone is powerful. The IRS lets you deduct the cost of your building over 27.5 years. On a $200,000 property, that's roughly $7,000 a year in paper losses, which can shelter thousands in rental income from taxation. This is a real edge that stocks don't provide, but it requires a good accountant, and that costs money too. Year 16, Jake gets his property reassessed. Property taxes jump 32%. He also discovers his insurance carrier is dropping his policy, wildfire risk reclassification. His new policy costs 40% more. 2 line items, both outside his control, both permanent. Concentration risk. This is what it looks like when your entire investment strategy depends on one property in one zip code with one tenant under one set of local regulations in one insurance market. Everything that matters is in one basket, and you can't even see all the eggs from where you're standing. Marcus, at year 16, invested in 4,300 companies across 11 sectors and 27 countries. If one company goes under, he barely notices. If one sector collapses, he barely notices. If one country's market crashes, he barely notices. This is what diversification actually means, not spreading around, disappearing the risk.
Year 17. Jake considers selling. His kids are almost in college. He wants liquidity. But selling a property isn't like selling a stock. Agent commission, 6%, capital gains tax. He'll owe the government a significant amount. Closing costs, another 2%, Exit costs eat roughly 8 to 10% of his sale price before he sees a dollar. Liquidity, the word that real estate investors undervalue until they need it. Marcus can sell 10% of his portfolio in 37 seconds. No agent, no closing costs, no 3-month escrow process. He transfers, it clears in 2 days. His money is never trapped. This matters more than anyone admits until life gets complicated. Year 18. Market boom continues. Jake's property hits $390,000. His equity is now $210,000. He refinances one final time to pull out some cash for tuition. He resets his mortgage clock. 30 years to pay off. Again. He is 52 years old. Refinancing resets your amortization. In the early years of a mortgage, most of your payment is interest, not principal. Every time Jake refinances, he goes back to paying mostly interest. His equity builds slower. His true cost rises. The bank wins every time the clock resets. The bank loves a refinance. Marcus at year 18, $562,000. His contributions are the same. The market did the lifting. He is planning early retirement at 55, not 67. He is 2 years away from having enough. He didn't sacrifice, he didn't hustle. He just started and stayed. Year 19. Jake's neighborhood is gentrifying fast. His property, now 40 years old, needs serious updating to compete with new builds. He's looking at a kitchen remodel, bathroom updates, new flooring, $40,000 to $60,000 to keep it market competitive. He doesn't have it. He borrows it on a HELOC. His debt rises. His stress rises. He is 53 years old and starting over again. This is the silent killer of real estate returns. Reinvestment requirement. To stay competitive, you must continually reinvest in the asset. A stock index fund requires zero reinvestment. It upgrades itself. Companies that fall behind get replaced. Companies that grow your wealth. No contractor, no permit, no HELOC. Year 20. The moment both men arrive at. Jake sells. The developer is back. Price, $420,000. After agent fees, capital gains, closing costs, he nets $348,000. He pays off the remaining mortgage, $160,000. Cash in hand, $188,000. Plus the equity he pulled out over the years, $55,000. Total real estate wealth generated, $243,000. Marcus at year 20, portfolio value, $714,000. He contributed $170,000 over 20 years. The market compounded the rest. He did not sell. He has no plans to sell all of it. He withdraws 4% per year, the rule of thumb for a sustainable retirement income. That's $28,000 a year from his phone. He is 54 years old. Now here is where this story flips the script, because Jake isn't done. He took that $243,000 and he invested it all into index funds, right now, all at once. And if he leaves it for another 10 years, it becomes $631,000. Late, but still powerful. The math at year 20 tells a story that surprises everyone. Jake's total generated wealth, $243,000 liquid. Marcus's total portfolio, $714,000. The gap, $471,000. But that's not the whole comparison, because Jake also lived with stress, sleeplessness, and a relationship under pressure for 20 years, and those don't show up in any spreadsheet. But here's what Jake has that Marcus doesn't: experience. He understands a real asset in a way Marcus never will. He knows what a cap rate is. He knows how to read a rent roll. He understands leverage, negotiation, local markets. If he does this again, smarter, with professional management from day one,
In a stronger market with better deal selection, he could outperform Marcus significantly. And here's what Marcus has that Jake is only now building: optionality. He can live where he wants, take any job he wants, say no to things that don't serve him. His wealth is not tied to a zip code, a tenant, a lease agreement, or a contractor who doesn't show up. Freedom isn't a feeling, it's a financial position. So, who won? 20 years, same starting point, different paths. Marcus has more money, substantially more money. Jake has more knowledge, hard-earned, real, valuable. Marcus has more freedom. Jake has more stories. Neither of them is wrong, but only one of them got there without paying with their health.
Here's the insight that this whole story points to. The best investment isn't the one with the highest gross return. It's the one with the highest risk-adjusted, time-adjusted, stress-adjusted, and life-adjusted return. Nobody teaches you to calculate that number, but it's the only number that actually matters. Most people compare investments by asking which one made more money. The better question is, which one gave me the most life per dollar invested? Because money is not the point. Money is a tool. The point is what the money makes possible, and whether the path you took to get it left you with enough time and health to enjoy it. Let's talk about what both men should have done differently. Jake should have stress-tested his investment before buying. What happens if there's a 6-month vacancy? What happens if the roof needs replacing in year 5? What happens if interest rates rise 2%? If the answer to any of those questions is, I can't survive that, the investment isn't ready. You aren't ready. Marcus's one mistake: he was so passive that he left money on the table. He could have used tax-advantaged accounts, maxed his 401k, his Roth IRA. He could have done tax loss harvesting during the down years. He could have rebalanced strategically. Passive doesn't mean thoughtless. The best investors are lazily strategic, not lazily ignorant. Here is what the data actually shows about wealth building. The number one predictor of investment success is not asset class, not timing, not stock picking, not property selection. It is time in the market. The investors who win are the ones who start early, stay consistent, and never stop. Everything else is noise. If you're listening to this and you haven't started, this is the moment. Not next month. Not when you have more money. Every year you wait has an exponential cost. $1,000 invested at 25 becomes $10,000 at 65. $1,000 invested at 35 becomes $5,000. Same money, 10 years earlier, $2,000 difference. Time is the asset you can never buy back. Now, let's address the argument you're forming right now. But what about real estate investors who did get rich? What about the people with 10 properties and passive millions? They exist, they are real, but they are not average. They had access to cheap debt at the right time, the right markets, the right management, and often the right amount of luck they'll never admit to.
Survivorship bias is one of the most dangerous cognitive traps in investing. You hear the wins, you don't hear the losses. The failed landlord doesn't make a podcast. The person who bought at the peak and sold at a loss doesn't give YouTube interviews. The noise you hear is curated. What you're not hearing is the full picture. Real estate can absolutely be the right vehicle for the right person with the right setup at the right time. If you love the operational side, if problem-solving energizes you, if you have skills in construction, negotiation, or local markets, the upside can be extraordinary. The point isn't that real estate is bad. The point is know what you're actually signing up for. And index fund investing is not the solution for everyone either. It requires emotional discipline in down markets. The investor who sells during a crash locks in their losses. The investor who buys more wins. But most people panic. Most people sell. The simplest investment strategy in the world has a very human failure mode. The real enemy of wealth is not bad investment choices, it's behavior. Buying high, selling low, chasing returns, abandoning strategy. Vanguard did a study called The Behavior Gap. The average mutual fund returned 7% annually. The average mutual fund investor earned 4.3%. Same fund, nearly 3% less because of behavior. Jake's story and Marcus's story end in nearly the same place, but they didn't live the same life to get there, and that's the point. Not which investment wins, but what does building this wealth actually cost me? In time, in stress, in relationships, in sleep, in freedom. Every investment has a price that doesn't appear in the prospectus. If you're 30 years old and thinking about your first $50,000, here is what the numbers actually suggest. For most people, most of the time, the boring path wins. Automate, diversify, stay in, don't touch it. Let compounding do what it's designed to do. You are not smarter than 20 years of consistent growth. But if you have the temperament of a builder, if sitting still feels like dying, if you want to understand leverage and negotiation at a visceral level, real estate might be your path. Just price in your time. Just build your systems before you build your portfolio. And just be honest, brutally honest about what you're signing up for.
There is a third path that Jake and Marcus didn't take, but that you can. REITs, real estate investment trusts. You get the real estate exposure, the dividend income, the appreciation without owning a single property. No tenants, no toilets, no 3 a.m. phone calls. You invest like Marcus. You're exposed like Jake. Best of both worlds, or at least closer to it. The real insight of this story isn't stocks beat real estate. The real insight is most people choose their investment strategy based on what looks impressive, not what actually serves them. A property is a conversation starter. An index fund is not. And we are wired, dangerously, to value what we can talk about over what actually grows. Status investments are real. We buy things that signal success, not just generate it. A rental property signals I own something. An index fund signals nothing. But silence is not failure. The quietest portfolios often belong to the wealthiest people in the room. The loudest real estate investors are often the most leveraged. Here's your takeaway from 2 decades of Jake and Marcus. Number 1, calculate your true return, including time, stress, and opportunity cost. Number 2, start earlier than you think you need to. Number 3, automate what you can. Remove friction from good behavior. Number 4, choose the path that aligns with your temperament, not someone else's highlight reel. Number 5, the best investment is the one you actually stay in. The conversation about wealth is broken. It's dominated by people selling courses on one side and people selling fear on the other. The truth is less dramatic and more powerful. Consistent, low-cost, diversified investing, started early and held, has made more ordinary people wealthy than any other strategy in financial history. But knowledge without action is just entertainment. You watched Jake make the same mistakes most people make. You watched Marcus do something most people find too boring to commit to. And now the question is, what are you going to do before this video ends, before the next distraction arrives, before the moment passes and becomes another thing you meant to do? Open the account today, not tomorrow, not after you understand everything. Understanding grows through doing, not through watching. The person who opens the account imperfectly today will outperform the person who waits for perfect conditions forever. Perfect conditions are a myth. Imperfect action compounds.
The wealth gap in this country is not primarily caused by income inequality. It's caused by investment access inequality and the behavioral gap that follows from financial illiteracy. The people who don't invest aren't bad at math. They were never taught. This is why this video exists, not to sell you anything, to close that gap, starting right now. Marcus's final message, if he could give you one: don't make it complicated, low-cost total market fund, automate monthly, reinvest dividends, don't sell when it drops, don't celebrate when it rises, just let time work. That's it. That is the entire strategy. It fits in one sentence because it doesn't need to be complex. Jake's final message, if he could give you one: Know what you're buying. Not the address, the business. Price in everything. Your time, your sleep, your risk, your exit costs. If it still makes sense, do it. If it only makes sense on paper, walk away. Real estate can make you wealthy, but it cannot make you wealthy cheaply. 20 years, 2 different lives, one number roughly similar in the end, but built on completely different foundations. One has money, the other has money and time. And if you had to choose between the two, which one would you actually want? The smartest thing you can do right now is share this with someone who needs it, not because we asked you to, because the person you're thinking of right now, you know they're about to make a decision without the information in this video. You have 12 seconds to send it before you forget. Do it. If you got this far, you're not average. Average people skip the part where money stops being abstract. You stayed, which means you're already in the top 10% of financial awareness. But awareness without implementation is just well-informed poverty. The next step isn't another video. It's an account. It's a number. It's a start. 20 years from now, you will either be the Jake of your story or the Marcus of your story. Or, if you do this right, something better than both. Someone who understood the full picture, chose their path intentionally, and built wealth that costs them as little life as possible. That person exists. You are at the beginning of becoming them.
Subscribe? Not for us, because the next video in this series will show you exactly how to build that third path, the one that accounts for everything Jake missed and everything Marcus left on the table. The full picture, the real math, the actual strategy. It drops next week, and if you miss it, it will cost you. Jake and Marcus aren't real, but the math is. The mistakes are real. The patterns are real. And somewhere right now, a version of Jake is signing papers on a decision he hasn't fully priced in, and a version of Marcus is setting up an auto invest that will quietly change his life. Which story starts today is yours to write.